Okay, great. So I get started. Thanks very much for this opportunity, Christos, for presenting my work. So I've read quite a bit of economics work on tech administration over years, but I haven't had many opportunities to engage with economists directly on this topic. And so I'm really grateful for this opportunity. So the paper today has one main goal. It's an attempt to document an important and previously neglected tax administration practice, mandatory taxpayer self-inspections. I'm going to be discussing this in the Chinese context. I showed that this practice is of first order significance in China. I'll explain that there are two types of tax administration units in China that carry out what one might want to call audit functions. The first is called the tax inspection system, and the other is lesser known, but it's much greater. It's called the revenue management system. So what I'll be showing is that the practice of taxpayer self-inspections, mandatory self-inspections, represents about 50% of tax inspection activities in the tax inspection arm. The revenue management system in Chinese tax administration is much larger, about 5 times larger than tax inspection. And in that system, over 90% of audit-like activities may be represented by self-inspection. So that's how important this phenomenon is. So much so that I think once you consider these simple facts, you can ask the question, is there any scope for proper audits in China? So I think one plausible answer is that actually there are nothing that we could properly call audits in China. So self-inspections can be conceived as a form of informal bargaining for payments. And so this is one way to look at the general implications for studying this phenomena. I think economists may be interested in this phenomena for many other reasons. This practice definitely deserves a closer look. I can imagine game theoretical analysis of what actually goes on. But for me, as a legal scholar, I focus on a conceptual argument. I want to say that the reason the phenomenon of self-inspections matter is that it motivates a reconceptualization of the centrality of audits in tax administration. So I think focusing on this point, I think it's common for us to take the significance of audits for granted. Certainly, audits is definitely an important part of the academic literature on tax administration, and that's observed not only in the literature on audits, but also on third-party information reporting, on paper trails, on tax amnesties, and on state capacity in general. Also, just to illustrate the centrality, I think if you talk to any research about Chinese taxation, it's quite common to ask, what is an audit in China? It's common to assume that maybe some tax returns are audited, taxpayers will behave in a certain way in response to audit, and audits is an important coercive tool at the tax administrator's disposal. And so we simply assume that that must be done. And I think what is important here about this project is to show that actually that assumption may be false. What we assume naturally must happen actually does not happen. So this raises the question of under what conditions are audits important or not important. I think we have enough data to show that audits may not always be the most effective at raising revenue. In the Chinese case, if we think about the enforcement elasticities of self-inspection, that seems to be substantially higher than for government inspections. And so if we think about why audit is important, it turns out that that may not be justifiable on the basis of the ability to raise revenue. There's an alternative view. It seems commonsensical. That's why a law professor can think of it. Is to say that audits enforce a social and legal norm of truthful reporting. Taxpayer self-inspections abandon that norm, do not enforce that norm. Tax amnesties is another phenomena, another practice that have been discussed has been discussed by researchers. That's another practice that abandons the norm of truthful reporting. But that's what audit is about. Audit enforces the norm of truthful reporting. So audits are important only when, unlike Chinese tax administrators today, rely on the norm of truthful reporting. So you can have bureaucratic units called audits. You can have activities that are called audits. But if tax administrators are not really enforcing the norm of truthful reporting, I think it's open to question whether that's audit at all. So one literature that this directly relates to is central to the economic literature on tax administrations, of course, is the respective roles of enforcement versus social norms. So we have the classical models of enforcement and deterrence in Cunningham and Sandville and so on. And there's a long debate about how important social norms are, and there's recent empirical work on actually studying social norms. So I think what I present here could be viewed as consistent with all this literature recognizing the importance of social norms. What is novel about this, what I'm presenting, my conceptual claim, is that the central enforcement strategy that have always been studied by economists, which is audit, that actually is understandable only in terms of enforcing a social norm. So these are not in parallel, not mechanisms in parallel. We can make sense of audit only in connection with social norms. So the norm of truthful reporting is enforced not just by the government, but also by private parties. That's one important reason to highlight that this is a social norm that's in play. By the way, this is also why I'm doing this as a legal scholar. It's a legal norm that we're studying. So this has implications for different strands of literature. In the current draft of the paper, I identified two. One is the theory of optimal tax administration. There's a relatively recent paper by McKean and Joe Slemrod. And the idea is that the enforcement elasticity of revenue can be a sufficient statistic for thinking about various issues. One is choosing the right mix between enforcement and setting tax rates. And there's already some recent papers in the developing country context to study this question. Alternatively, for people interested in tax administration, one can also raise the question about how to balance different resources between different tasks. So online, there have been a couple of recent presentations that drew my attention. And so a while ago, Nadine Riedel presented a paper with co-authors that showed that in South Africa, tax authorities were able to mechanically increase tax registration rate, so improve on that front of tax administration, but they observed a drop of timely filing among taxpayers because of these new entrants, newly registered taxpayers. There's a paper studying Rwanda showing that timely tax filing was improved in Rwanda, but at the expense of decreasing the accuracy of tax returns. So up to 60% of Rwandan corporate taxpayers enter zero on all entries of their tax returns. So that's quite striking. So I think questions are going to come up very soon about how to evaluate these different components of tax administration. And there's an obvious theory that seems to be a candidate, which is the theory of optimal tax administration. So this paper I'm presenting shows that there are limits to the theory, in particular where social norms are relevant, the enforcement elasticities of government interventions may be indeterminate. So the particular example I focus on is this following puzzle. When you suppose you have a highly non-compliant environment where people do not follow the norm of truthful reporting, then the direct revenue gain from audits, if you audit taxpayer, most taxpayers are non-compliant, and if you audit them, you're likely to catch cheating, and additional tax liability is due. However, there's another instrument, which is pure bargaining, taxpayer self-inspection, which may lead to even higher revenue gain. When you do have a compliant population of truthful reporting, the direct revenue gain from audits may be lower because taxpayers are already compliant. And so in the US and Canada, the percent of audits that end up with no adjustments is quite significant. But still, this can be higher than the gain from bargaining because we don't accept bargaining for rule of law reasons. Okay, so I think of this as a interesting puzzle for the theory of optimal tax administration. I think I'm going to skip this slide for the implication for literature state capacity. I can come back to this later. So the outline of the presentation is I will talk about some background on Chinese tax administration. There's a hurdle here about the distinction between tax inspection and revenue management. I think I have to talk about that, unfortunately. So I will explain that. Then I will present data on the evolution and prevalence of self-inspections in the tax inspection system. This is based on public national data. Then I'll talk about self-audits in the revenue management system. That's data from one province. It's internal bureaucratic data, so it's not public, but it's fairly simple. By the way, everything I do has no complicated econometrics. I'm just trying to show some facts that I think have straightforward interpretations. And then if I have time left, I will go into a conceptual scheme for analogizing self-inspections with tax amnesties, but also drawing distinctions, justifying a view of tax inspections as a form of informal negotiation, and then talk about a classification of tax administrator interventions into ex ante versus ex post categories to show, to make a conceptual argument that the norm of truthful reporting is really essential to the concept of an audit. And then I will conclude. So that's the plan for the presentation. Any questions so far? Okay, I'm going to move on. So the first part is the background China's tax administration. So I think one point is worth making is that China is an important case study for tax and development. And so here I show using data from the World Bank that back as recently as 1995, China's GDP per capita is at the same level of sub-Saharan Africa, excluding the high-income countries. So that's very low. This is about the time that China set up its current tax system. So GDP per capita increased in China, but not until it did not surpass the level of South Africa until 2013. It did not surpass the level of Mexico until 2018, and it's still below the level of Costa Rica. So there are recent papers studying these countries. I chose these countries. There's a paper by Anne Brockmeyer about enforcement in Costa Rica. That's very interesting, presenting Costa Rica as a developing country. More recent paper by Anne and co-authors about property tax enforcement in Mexico, again, presented as a developing country. And Nadine Reeder's paper about South Africa. So I'm showing here that even though China seems very powerful, it is a squarely in the developing country, lower or middle income category until very recently. However, around the time of 2004, when China's GDP per capita was substantially lower than these other countries, the tax to GDP ratio reached above 25%. It's been moving up since then. So this is very successful tax collection. And another way of showing this is that if you look at the growth rate of GDP and versus tax revenue, the blue series is GDP growth in China, which is very high. But you can see that for most years since 1997, the revenue growth rate dominates the GDP growth rate, so extremely fast revenue growth. So that justifies looking at China as a case of successful tax collection in a developing country. So very quickly, the organization of Chinese tax administration has been very little studied, even by scholars in China. And so most people will have a view that the most important thing about Chinese tax administration is that it's divided into two systems, the Guoshui system and the Dishui system. These are bureaucratically distinct, most importantly, in that they collected different taxes. and the State Tax Bureau had direct control from the central government, whereas the local tax bureau is controlled from the provincial government down. That distinction ceased to be important, and for in 2018, because the systems were merged. What I present today applies to both systems. Okay, so definitely it's not enough just to say that you have guo rate versus yi rate. I'm writing a book, almost completing a book about Chinese tax administration, the administrative foundations of China's fiscal state. There I discuss two other features of the organization of tax administration. One is that tax agencies form a dense grassroots network. And so the most helpful analogy is that there are as many tax offices as there are post offices in the US, and that's over 30,000. Okay, so going to a tax office and meeting your tax administrator is as convenient as going to a post office. Back in the 1990s, or mid 1990s, there actually literally are as many tax offices as there were post offices in China, and this was 60,000. Another phenomenon is that at the grassroots tax agencies, in these offices at the grassroots level, there's lack of specialization. So between 40 and 80% of tax administrators work at units called branch bureaus, outposts, or revenue management divisions, and county or city level bureaus, where there's little differentiation in different tasks. And so let me show this slide. Oh, okay, so I will come back to that, the lack of specialization. One aspect of Chinese administration was intended to be specialized. This is the tax inspection arm. So the Jicha arm of tax bureaucracy is organizationally distinct. 80% of county or higher level bureaus have a separate division called a Jicha, or tax inspection bureau. The tax inspection system has a separate annual yearbook that contains annual reports about the performance of the system, and that's a distinct yearbook from the China's taxation yearbook. Researchers have tended to take tax inspection to represent Chinese tax enforcement. It sounds like it, right? And conveniently, there's a yearbook from which you can gather data. So empirical studies of Chinese tax administration almost uniformly draw on tax data from the tax inspection yearbook. A problem with this is that the tax inspection arm is actually a minor branch of Chinese tax administration. So I show in these figures that in terms of personnel, tax inspection staff has been going down, and as a percentage of total tax administration staff, the percentage has been going down. Even at its height in the early 2000s, tax inspection represented no more than around 15 or 13% of total tax administration staff. In more recent years, it's much lower, it's less than 12%. Okay, so it cannot be the case that tax inspection is the main enforcement arm of Chinese tax administration, because what do the remaining 80% or 88% of tax administrators do? So this data is from the China taxation yearbook. There's quite a bit of provincial variation, and so tax administration is heterogeneous across regions in China. But even so, you can see that in terms of ratio of tax inspectors to total tax administration personnel, even in the highest provinces, is not more than 30%. Okay. So what do the bulk of Chinese tax administrators do then? The dominant taxpayer-facing division is called revenue management. Revenue managers are assigned to specific taxpayers, generally hundreds and mostly businesses, and they're assigned on a rotation basis. Revenue managers, or teams of them in frontline offices, have great discretion in varying weights given to different administration tasks. These include taxpayer services, account management, examination audits, delinquency collection, and other tasks. All of them face revenue targets and other performance metrics. Most of these are based on observable outcomes. And so the point to make is that examination audit is only one thing that they have to do, and they have a lot of discretion choosing whether to do it or not. If there are more effective ways of meeting their revenue targets, they will probably choose that. So to conclude this, I think this already raises an easy, obvious question. What is an audit in China? When researchers make the claim that Chinese taxpayers are audited, one should ask the question, who is doing the auditing? Is it the tax inspection bureaus or revenue management divisions? Usually researchers may not be able to answer that question. That's how little we have known about the organization of tax administration. And it turns out that neither one does much by way of proper auditing. So that's what I show in the next part. So the next part is about self-inspections in the tax inspection system. What are taxpayer self-inspections? They are reviews carried out by taxpayers themselves about whether they have paid taxes according to official requirements. They're carried out upon the order and instructions of local tax inspectors, so they're mandatory. Additional tax liabilities reported upon self-inspection would attract no penalties. Penalties, in theory, could vary between 50 and 500%. That's on paper. In reality, penalties are relatively rarely imposed. It's very difficult to impose penalties. Generally, self-inspections are not used in investigations that are based on whistleblower reports, other specific allegations of violations, or suspected criminal activity, but they are used for broad coverage inspections. So there are several of these. There's something called the special issue examination that's usually targeted at sectors or particular tax issues, or they could be targeted at taxpayer segments in terms of size. There's no basis for taxpayer self-inspection in the law, and has not been previously documented by researchers. Even though if you read government reports and administrative guidance, nowadays it's easy to access these through legal databases. You can easily pull up older documents and observe discussions of this practice. So this practice evolved over time. Self-inspections were used immediately after the modern tax system was established in China in 1994. It was promoted by the National State Administration Taxation. At that point, when it was first used, self-inspections was presented as a low-cost audit technique that permitted the expansion of audit coverage. And so there were too many taxpayers to audit. Taxpayer administrator resources are constrained. Why don't we ask them to self-inspect first? By the early 2000s, provinces began to publish formal guidance for self-inspection, so there are some official documents to read. In 2008, around 2008, two things happened. One is because of the global financial crisis, the tax inspection arm of tax administration got its own specific revenue targets. And this led to an even greater use of self-inspections. Another thing is that large taxpayer units were set up around 2008, and that gave a new impetus to use self-inspections, because whereas there used to be too many taxpayers, now we are facing taxpayers whose affairs are too complex. And so self-inspection received another rationale. Here's the typical process for taxpayer self-inspections. A taxpayer population is selected based on common characteristics. It could be the industry, it could be the size. This is the general approach to tax inspections in China. So I think it's already very notable that tax inspections are not based on examinations of individual tax returns. In fact, tax inspectors do not normally access tax returns. I explained that in a bit in the paper. So tax inspection teams would advertise an upcoming inspection campaign among the targeted population. They would hold individual or group meetings with taxpayers to outline the laws and policies inspectors wish to enforce. Some places where this practice was formalized earlier, there will be a formal notice setting out procedures. But the procedures are basically, you need to carry out the self-inspection during a limited period of time, 10 days to a month. And you can submit a self-inspection report that reports additional tax liabilities. Self-inspections are held generally with the threat of subsequent government inspections. Tax bureaus often specify minimal ratios of taxpayers for subsequent government inspections. And this minimal ratio is generally supposed to be higher than 20%. And that's, of course, much higher than the coverage ratio of tax inspections in general, which is less than 1%. So how are taxpayers selected for government inspections after self-inspection? Sometimes this is explicitly said to be randomized. Sometimes it's simply said that this is not randomized. It depends on outcomes of self-inspections. What does it depend on? We don't have information about that, but I think it's unlikely that selection is based on self-inspection reports or on some standard strategy or algorithm for audit selection. On this first point, I can show you that this is an example of a self-inspection report where basically a taxpayer says, you've asked me to self-inspect. This is the additional tax liability I would report for different taxes. So each column is a tax and each row is a year. You don't have additional information from taxpayers. So this is much more impoverished in information compared to a regular tax return. And so based on this, I can say that I'm confident that this is not going to contain information anywhere close to a tax return itself. Okay, so that's the general institutional background. How important or prevalent are taxpayer self-inspections? I draw on tax inspection yearbook data. So the thing to know about this data is up until 2007, the yearbook provides tabulated data on tax inspection outcomes and does not distinguish between self and government inspections. We simply don't know whether this data covers only government inspections or covers both. There are features, moments that can be that suggest either interpretation. Chinese economists have only used this kind of tabulated data before. However, provincial reports in yearbooks separate self and government inspection outcomes. It's possible to hand gather data and construct a unbalanced panel. That's what I did with a PhD student. Provincial reports also document practices qualitatively. And so a lot of the institutional history that I just rehearsed in the previous slides, I had no other reason for knowing. It's actually just from reading these reports. So the following figures will focus on three metrics: taxpayer coverage, contribution to inspection to total revenue, and then finally, additional liabilities determined per taxpayer. So I show here that in terms of taxpayer coverage, we have graphing. This is the dividing line 2008. So before that, we don't have separation between self and government inspections, but this was the trend. We can see that taxpayer coverage for government inspections have generally been coming down. There's a dramatic decline. This is national total on the vertical axis, and I separate these two figures. One is the Guoshui system, one is the Dishui system. In both, you can see that the blue series is represented by, the blue series represents self-inspections, so taxpayer coverage and self-inspections, and the red series is government inspections. You can see that in all years nationally, the number of taxpayers covered by self-inspections dominate government inspections. Contribution to total tax revenue. When we look at the post-2008 series, self-inspections and government inspections are comparable. Okay, and so whatever tax inspection bureaus are measured, evaluated based on whether they meet revenue targets, and that's one of their performance targets. And self-inspections contribute equally to that standard, to that metric. And then per taxpayer adjustment, here's is one place you can see a overall increasing trend. I think that's probably attributable to the increasing focus on large taxpayers. Not surprisingly, this is more volatile. You're examining different populations, but you can see here as well that self-inspection and government inspection, even though government inspections are supposed to be more selective, per taxpayer adjustment are comparable on average. So that's the summary. Self-inspections seem to be extremely important for the operation of the tax inspection system. There are additional facts that I discussed in the paper. This pattern holds across reporting provinces. I only showed national average. It turns out that this is not due to some outlier. And then I have some simple regressions showing that both types of tax inspections, whether self-inspections or government inspections, are quite sensitive to revenue pressure experienced by provinces. Okay, so that's, I think that's striking. It's a set of facts that are open for public view. So tax administrators have talked about this practice ever since the tax inspection yearbook was published in 2002, but no one has paid attention to this practice. Next, I turn to data from one province. This is self-audits in the revenue management system. This turns out to be much more important. Because revenue management is the main enforcement arm of Chinese tax administration, as I tried to show, this is the bulk of Chinese tax administration. In this system, verification of tax returns is supposed to be carried out under the rubric of taxpayer evaluation. This is a very opaque terminology, and so we couldn't really find anything written about taxpayer evaluation by scholars. But that's a quasi-audit function. Basically, tax revenue managers are supposed to evaluate how accurate returns are, how compliant taxpayers are. This is not a specialized task. It's the same people who carry out taxpayer services, delinquency collection, account management who do these things. And so specialization is lacking, and centralized risk detection is very underdeveloped. So encouraged by the SAT, some provinces in the last decade rolled out tax administrative reform in this respect. They want to develop better taxpayer evaluation. They want to develop better specialization and also better risk management. So the typical strategy would be, so this applies across provinces that engage in this reform. The easy strategy is to centralize taxpayer service, and therefore many tax administrators no longer have regular contact with taxpayers. Some of these tax administrators are assigned to risk response units that perform only audit functions. They are no longer doing any other administrative activity. And so they don't do collection, they don't do account management. They will contact taxpayers only when the information system of the government identifies certain taxpayers as potentially risky. And this information system is supposed to be based on tax returns. And the risk response unit is entirely separate from traditional tax inspection unit. So I'd be describing a set of outcomes that you can describe as audit outcomes, but it's important to remember that this happens completely in parallel to the tax inspection system. So one province that carried out this reform is Jiangsu, which is a rich coastal province known for high quality tax administration. This is a province just north of Shanghai. So formal audit units within revenue management was launched around 2013. These units engaged in what's called intermediate risk response towards, on average, 5% of Jiangsu's business taxpayer population. That's 6 to 10 times higher than Jiangsu's tax inspection coverage. Okay, so if we think of these as audits, and if we pretend that the tax inspection system carries out audits, this is a very large expansion of formalized audits. The new audit functions directly result in revenue collection equal to about 4% of total tax revenue. That's compared to about 1% of tax inspections contribution. So what I have is internal reports about the outcomes of new audits, intermediate risk response across 13 cities in the province and over 10 quarterly periods. So it's not terribly granular. I have more granular data about some cities, but it's hard to construct a panel. So, empirical facts I want to show, they're quite striking. I'll call them audit outcomes, although in the end, I think it's quite questionable whether what's going on is audits. This is the outcomes of the new formalized audit system in Jiangsu. So audit procedures happens in this way. The first step is that the taxpayers identified as potentially risky would typically be invited for a interview at tax administrator office. Remember, tax administrator offices are very close by, and so there's no correspondence audits. Everything starts with an office or desk audit. Okay, and so you have a meeting. There are office desk audits in the United States, Canada, other places as well. And very often those audits could just end there. So taxpayers answer all the questions asked. This is not the case in Jiangsu. Only about 2% of cases end with an office meeting. Most of them proceed to one of 3 forms of audits. The vast majority is shown here, about 80%. The vast majority of the audits end with a self-audit. Okay, and the word for self-audit in this context is the same as for self-inspection in the tax inspection system, 自查. Okay. What about the remaining about 20%? So those, a small percentage, less than 5%, is the office will proceed directly to a field audit. Okay, so there's no chance given for a self-audit. But a greater portion happens, it's a 2-stage audit. Taxpayers are asked to engage in self-audits first, and then that's followed by a field audit. Okay. So what we see here is a remarkable replication of the pattern we saw in the tax inspection system, where most audits are carried out and completed through self-audits. Moreover, the ratio of government audits to self-audits is comparable to what we saw in the tax inspection system. This is remarkable because this is a new system in Jiangsu, and where it's practiced in other provinces, it's also new. There's no instruction, there's no manual for doing this. This is, in a way, spontaneously what happened. And we saw this spontaneous, remarkable replication of a pattern in the tax inspection system. Now, how important are self-audits? And so what I show here is the proportion of total adjustments and the likelihood of adjustments. So in the left panel, from this kind of new formalized audit, on average, and so here the observations are city quarterly observations. And so what we have is on average, 95% of adjustments from audits come from self-audits. The median is also about 90. Okay, so this is the basis of the claim that over 90% of what's called the audit activity actually is self-audits. If we look at the percent of audits ending with a positive adjustment, tax administrators are more successful in getting adjustments through a self-audit compared to a field audit. So even though field audits are carried out, more often tax administrators come away empty-handed. Of course, that's only 70% of the time, but compare that to 30% of the time, but compare that to only 5% of the time coming away. So self-audits are much more successful than government audits. We look at size of adjustments per taxpayer, and so the data doesn't provide doesn't provide the whole distribution. It simply provides percentages for different categories. So we will see here on the left panel, it's adjustment smaller than 100 Chinese yuan. So that's a very small amount. It's a trivial amount of adjustment. What we see here is that a greater portion of field audits attract this kind of trivial adjustment. This is less common in the self-audit system. If you look at adjustments of greater than 100K Chinese yuan, then you will see that self-audits are more frequently resulting in this kind of very large adjustment than field audits. Right? This is very surprising, given that when we think that the field audits are more selective, it turns out that they're less successful. So in the paper, I provide some additional statistics. I think I'm going to run out of time. To wrap up, I would say that if you do a back of the envelope calculation, you can do 3 stages. You can say that between self and government inspections, that's the tax inspection part, we assume that 20% of self-inspections are followed by government inspections. The ratio of government versus self-inspections would be roughly 1:4. And then, given the average adjustment per taxpayer is similar for both types, self-inspection comes out ahead in terms of revenue to cost over at least 300%. The second comparison is between risk response, this formalized audit in the revenue management system that I just described, versus tax inspection. The caseload is roughly 12:1. And so revenue managers who do audits are able to finish about 22 cases a year, whereas tax inspectors finish on average less than 2 cases a year. For taxpayer adjustment is larger in the tax inspection system, but not by 10 times. It's about by 8 times. The result is that the intermediate risk response system comes out ahead 50% at least. And then if you compare self and field audits in revenue management, self audits also come out ahead by a lot in terms of effectiveness in raising revenue. Okay, there's no data yet from other provinces on outcomes in formalized audit units, so we cannot say this is generalizable. But I have figures showing that at least comparing the tax inspection system in Jiangsu from other provinces, they're roughly similar. Okay, so Jiangsu, I don't think is a total outlier. Okay, I think actually that's enough material to talk about. We don't have to talk about the conceptual scheme, but one contribution the paper tries to make is to propose a simple conceptual scheme to say that tax administrative tasks can be broken down according to these 2 dimensions. Taxpayers can be accountable for disclosing private information, or they may not be so accountable. Government can verify true liability or decide not to verify true liability. I would put normal audits in the upper left cell where taxpayers are accountable for disclosing private information, and then the government verifies the true liability. Okay, this is what we're accustomed to. You actually don't need this dimension. You can have property tax assessments where taxpayers are not accountable for disclosing private information. The government directly observes the tax base and then make an assessment. So these are equally good, equally important collection techniques. I would say that recent research on tax and development has really privileged this category. So a lot of property tax studies, I think that sort of biases what we think of as proper tax administration. Tax amnesties, something that I talk about in the paper at some length, is somewhat analogous to self-inspections, is where taxpayers are supposed to be accountable for disclosing private information, but on a occasional basis, the government forgoes the verification of that. Okay. However, there are disanalogies between amnesties and self-inspections, primarily because self-inspection is the main enforcement strategy. In that case, taxpayer does not disclose private information and the government doesn't verify true liability. That's a justification to say that neither side has information, provides the other with information about the true tax base, and therefore their agreement is based on pure negotiation. So I think I'm going to try to conclude this, skipping some of the slides. In the paper, I provide a Lockenomics version of this, but we can skip that. Conclusion: informal bargaining for tax payment in the form of self-inspections happens at a large scale in China. This is the preferred enforcement strategy compared to sustaining the norm of truthful reporting. Highly motivated revenue agents succeed in bargaining. Traditional audits play a secondary role. China has strong tax capacity in collecting revenue, but is this the kind of state capacity one wants? And I think this is the what's really interesting to me about this arrangement. And finally, it raises the question of what are audits good for? These findings potentially have implications for research and policy. And so Chinese, in my book, I talk about Chinese civil servants are highly motivated. There's so many performance metrics that are applied to them that determine their promotion and pay. And the result of that is that tax administrators can be quite successful. And so I was pleased to see that Jonathan Weigel is presenting in this series later this term. He had a paper studying tax compliance rate in the Congo where property assessors knock on doors, and the report was 10% compliance. Now, that really is very demoralizing for tax administrators. For China, I can tell you that, knocking on doors, basically think about these post offices chasing after taxpayers. Post office like, in terms of distribution, these frontline tax offices chasing after taxpayers, the compliance rate is much higher. Think about how high the self-inspection yield is. So we have a lot of motivated civil servants, but very little rule of law norms. Okay, that's sort of the state capacity that we're seeing. And implications for research when we think about how to optimize tax administration, it seems that the revenue cost calculus will be very complicated when we have social or legal norms that are endogenous with the choice of these strategies, and these norms are beyond tax administrator and policymakers' control. Thanks very much.
Thank you, Wei. Fascinating presentation and topic. Now, I would like to, ask colleagues if they have any questions to ask in a way. I'm happy to. Sean, can we unmute?
I mean, I can mute myself, so I'm assuming people can unmute themselves.
Oh, they can. Okay.
I believe so, because I could.
So it's not locked. Okay, that's fine. Okay, good. Yeah. So, please, if you have a question to ask in a way, just raise your hand. While you're thinking, maybe I start the discussion in a way. I think it's fascinating this this practice of self-audit. But somehow, thinking like an economist, if I'm invited to self-audit myself, then certainly I will have to find something, for the tax authority to verify. So in some sense, even though I might be, fully compliant, the fact that I've been asked, to self-audit myself, I tend to believe that the best strategy will be to find something to give the tax authority, because implicitly, I mean, there's a threat of post audit, following up on that. So in some sense, I don't find the the result that says, in terms of tax revenues, these self audits do pretty well. Do as well as government audits. But my expectation would be, and I haven't seen the data. I don't know to what extent you have the data. My expectation would be that when it comes to self audits, you have a lot of businesses providing additional resources in the tax authority, but when it comes to government audits, you have bigger amounts per audit, if you see what I mean. So you self-audit a lot, but they verify small amounts relative to what they would verify, had they been government audited, if you see what I mean. So it would be nice to tease out, if you have access to this data, it would be nice to tease out, what amounts are we talking about in these two different types of audits, government audits and self audits. That's number one. Number two, you stated at some point that these audits are there's informal bargaining going on which I don't really understand, is informal bargaining. And I would like a little bit of clarification on that. The other thing, I've got a couple other things I get to ask you. Now, yeah, in some sense, that goes back to your point about tax amnesties. And as you said, I think there's a lot of resemblance, going on between tax amnesties and self audits, because the self audits, I guess with self audits, you're precluding of, and it would be nice to see the data again. Now I'm thinking about this to see how many, maybe you said it and I missed it, and I apologize for that if I have. But it would be nice to know how many self audits have been audited subsequently, and what are the findings, and across what tax basis. I think that's interesting, because if they're not being audited, following the self audit, then that suggests, that's a great strategy. So maybe the strategy there for the tax authorities to self audit everybody, in China. Yeah, so going back to the amnesties, it has a great resemblance. Maybe the legality, maybe because I noticed something you said, and it's something that I would like to check with you. You said, I think, that self-inspection audits are not documented in the law. So they're not guided by some sort of procedural code that these tax inspectors have to follow, which is quite bizarre.
Yeah.
You would expect that even if it's a self-audit, then you should be expecting that there's no a lot of freedom in the for the tax inspectors to do whatever they want in some sense, but to follow some procedure.
Yeah.
Anyway, these are some kind of random thoughts that came to mind as you were going through the presentation. Might have something to add later on. Thank you.
Great. Yeah, no, those are great questions. Yeah.
The side, hopefully related question that occurred to me was, does this apply to all taxpayers, or is it just a subsection? In the sense that in the UK, we have 36 million taxpayers, but I would imagine 20 million of us never have any opportunity of this form. Our employers just handle everything, and we're not part of it. So we'd instantly be moving into that subpopulation, the other 10, 15 million taxpayers who may be in this situation and may have self-employment income, complex tax affairs, who may get into this sort of game. So in China, is that everybody that would be included in this kind of scheme, or is it that similar sort of subpopulation that you're interested in that would be effectively playing this bargaining game?
Great. Yeah. So, Christos, I'm happy to answer these questions, yours and Sean's, quickly. Sean's is the easiest to answer. So, like many other developing countries, the focus of tax administration is on business taxpayers. And so we're not talking about employees. So we're not talking about PIT.
It is that category, and that's what applies.
Exactly.
Okay.
Yeah. So in that regard, it's not very different from the UK system. And so among people who have business income, you have sole proprietors and you have business entities, and sole proprietors are audited far less often. They're more non-compliant, generally, people would say that. So I'm talking about the large population of general registered business taxpayers. And in that case, once you limit to that population, anybody can be subject to this kind of procedure. They can be inspected, they can be subject to risk management under the revenue management system, and they can be asked to self-inspections or self-audits.
I just with that, I didn't catch it, and I apologize about that. I didn't. But of that tax base, what portion is asked to self-inspect in any given period?
Yeah. So so remember, for tax inspection, there is a beginning, which is a targeted population, and that usually is by sector. Yeah. And by sector, that could change from year to year. And so one year it could be peddlers markets. Another year is gas stations. Another year is real estate companies, and so on. It could be large taxpayers.
Because the question I was going to ask is, does that vary because there's a revenue target on behalf of the tax administrator? And this whole thing is a game where they know the figure they've got to hit, and they target who they're advertising in any given year until they reach the 10 million or whatever it is that was their target in the first place.
So my prior, this is an educated guess, is that when you need revenue, the choice is not between sectors, it's between taxpayers of different sizes.
Right.
But other times people will vary audit because they don't want to be auditing people in the same people every year, so they change sectors depending on where the issues are arising. For revenue management, which matters much more, the selection is supposed to be based on tax returns, so like our normal audit, so it's not sector-based selection. And so that could, in theory, cover everyone whose tax return is sufficient, it provides sufficient information for you to talk about whether it's risky or not. To answer Crystal's question, the data is very, very, it's not very rich in information. And so in a way, what I'm doing is to say, here, this is the data. The people are telling you that they're doing this. We don't know anything about it. But definitely self-inspections are supposed to be followed by government audits. The minimal ratio ranging from 20 to 50% can be observed in different government reports. And so there's definitely follow-up. How rigorous those follow-ups are is a good question. The reason I call it a good question whether it's right to call this informal bargaining, there are two things to say. One is there's a lot of informal bargaining permitted by the proximity of tax administrators on a routine basis. And so putting aside these formalized audit units, just think about how revenue managers usually work. There's a lot of bargaining going on all the time. And so that's hard to document. So what this data permits is to say that now the government says we're formalizing audits, and here's something that we actually provide statistics for. I'm saying, let's look at this statistic. Because there's no verification of true liability, and there's no disclosure of private information, it can only be conceived as a form of bargaining. So I think that characterization is not essential for studying self-audits and self-inspections. It's one way of framing it. And so studying informal bargaining is so difficult that maybe we should look at this instead. That's the first thing. Second thing is that there's no law. And so this is completely, and this has been done for 30 years now. So 25 years now. So really it is a large piece of the world that is not codified, and it's very difficult to codify. And that supports this characterization of this as very utilitarian, very based on convenience of tax administrator, their immediate goals, and the norms or rule of law are completely disregarded. And so we can read formal procedures for self-inspections, but there are few procedural norms in there. Nor could there be, we're looking at modern taxes. What could be a procedural norm for self-inspections conducted year after year? It's very hard to imagine that. So that's another reason to say that this is really under the table practice.
Thank you. Weichen, if I'm pronouncing the name correctly, has raised a hand. Would you like to ask the question yourself?
Yeah, so I was wondering how it also applies to the large business unit, or how it's related to the 1000 Enterprise Initiative, and whether it's also related to the tax risk management, because as far as I know, the tax risk management is also not, there's also no law, but for example, in the stock on the stock exchange, it's actually required. So I was just wondering if it's the same for these kind of firms, or like large multinationals and state-owned companies.
Sure, I'm happy to answer that question. This is good for understanding the mechanics, the institution of self-inspections. So large taxpayers are very often chosen for tax inspections or audits for natural reasons, and self-inspection is used very often. And so this is not formalized in law. So you can say risk management is not formalized in law. That's correct. So there are internal bureaucratic directives for doing this. I think the reason what's striking about this is to say that self-inspection is not a practice confined to large taxpayers. And so we cannot interpret it in terms of administration concepts like horizontal monitoring, collaborative tax compliance, because it is applied to everyone. This is not a technique that is selected for large taxpayers alone. And so its logic really, it does not follow that. More specifically, in collaborative compliance, when you work with large taxpayers, you impose penalties less often on them, you adopt a different strategy. But a key defining feature is to ask them to disclose more information. And so in the Chinese context, when you have the large enterprises selected for as large taxpayers, they're asked to show a lot of their information. That's not what happens in the self-inspection and self-audit system. So I think that's there are other differences, but that one seems to be critical to me.
Thank you. Any other questions from the audience? Wei, are you aware of any other country using this self-inspection strategy?
Yeah, I'm not aware. I'm not too worried. I think people it's good enough to think about this in the Chinese context, because it's not like China decided to implement the system across the country at some point, right? And so this is emerging spontaneously in different provinces, in different cities. And second, my sense is that there's just a lot that we don't know about tax administration. And so I mentioned earlier the study that in Rwanda, the 60% of taxpayers enter zero on every line of the corporate tax return. And so the authors are, say that we don't know whether this is special to Rwanda, but maybe it's not, because we observe it in Uganda as well. The truth is that that happens at a large scale in China as well. And so, it could be 30% or between 20 and 30% of taxpayers entering all zeros in their tax returns. So these are simply phenomena that we haven't come to our radar screen as academics, but could be quite prevalent. And so this is just a first step to uncover this phenomenon.
Right. And if I can go back to the point, because this is quite striking for me, that self-inspections are not documented. There's no formal procedures guiding these inspections. Any idea why this might be the case? If they are so prevalent, why hasn't the state formalized? The states, the provinces formalized.
Yeah. Well, okay. So let me. That's a good question, and that is the central point of my presentation in a way. For me, there's a natural answer, is that it goes completely against the idea of enforcing a norm of truthful reporting. And so when China adopted the income tax, the VAT, Social Security regime, so all in the 1990s, the presumption is that it's based on self-assessment. The presumption is that there is a norm of truthful reporting. So in my book, I document how taxpayers and tax administrators did a lot in 1997 just so that tax returns can be processed. That's a whole system. The whole system is premised on the idea that there is a norm of truthful reporting. When you have that on paper, and you completely enforce it in a different way, it's very hard to write that into the law.
Yeah, no, that's a fair point. Absolutely. But having said that, at the same time, if you have the system, somehow you need to formalize it. So it goes both ways. Otherwise, you can't have something informal, because you incentivize, somehow I think incentivize people to collude, people to add the report, and then if they get invited to self-report, then they comply more. So it's kind of a it's kind of strange incentives. I think it gives rise to the system.
Yeah. I think that might go to the point that generally, lawyers, accountants, all of us take certain legal norms for granted, so that when practice substantially deviates, we don't really recognize the deviation, because we use the vocabulary of modern taxes, audits to describe all of these things. And so Chinese tax inspectors would say, we're doing tax inspections. How can you say that you're doing that when you're not looking at tax returns at all?
Indeed. Thank you. We ran slightly over time, but that's okay. It's an exciting topic. I think it's fine. Any other burning questions? Okay, for Wei, please, before we wrap up. No, good. Okay, thank you. Let me say big thanks again to Wei, for
Oh, thank you for joining this morning.
Yes, clap. Yes, there's a clap from Sean. Thank you, and have a good day.
Okay, I really look forward to participating in more of the TARC events coming up later this year and next year.
Thank you. Yeah, I mean, we're looking forward to having you. Absolutely, as everybody else. Thank you, and have a good day.
Okay, great.
Thank you.
You too. Bye.
Okay, all the best. Okay, bye.
Bye.
Cheers. Bye.